2 o'clock, and last night's session did take a full hour. We could have gone on for longer. So I will dive into this. We're going to briefly go over the things we talked about last night. If there's anything that you want for us to slow down about, let us know. Can you see the welcome to session 2?
Yes, and I just want to give you a heads up. Don't be offended if I have to, my daughter's sleeping.
Sure,
She might wake up.
Yeah, so I will, let me get to my attendees. I'm going to mute you.
I'm going to mute myself.
Yeah, okay, there we go. Okay, cool, so welcome to session 2, and I believe both of you were on 2 weeks ago when we talked, we had Chris Coyne on, and we were talking about insurance and why I became, or my experience as a landlord, and my, how I picked properties. So we don't need to dive back into why you're here or any of that. Today we're going to be talking with Mike Gliatone from Center City Mortgage. He's a phenomenal lender. He explains things so well, and I'm really excited to have him here. And you can, again, if there's more questions, feel free to reach out to him or me directly as applicable. And just so we're not also staring at Mike's mug while I'm talking, I will just change up the screen. Okay, cool. All right, so first time we talked about my experience as a landlord, strategies for picking properties. We talked about the benefits of real estate investing, so the tax benefits, equity buildup, appreciation, cash flow, and leverage. We also talked about the difference between real estate and stocks, how you have to, basically have 100% of the cash to invest in stocks, how you have to sell the asset in order to use the equity, whereas in real estate you don't. And we talked about managing risk with insurance with Chris Coyne. Some of Mike's stuff touches upon insurance because, whether you do an LLC or personal name, that's going to also affect your loan terms. So all of these topics are very interrelated. So the 3 strategies I want to talk to you today about how my clients are building their portfolios. There's 1 strategy for renters and 2 for homeowners. So the strategy from renter to owner, I consider the $1.2 million advantage, meaning that if you started out with a $1,000 monthly payment over 30 years at 3% inflation as a renter, which is probably very modest given that people usually end up paying more and more and more over time, that person will have paid $570,000 to their landlord. And just to give you an example, one of my first rental properties, I was charging about $1,100 18 years ago. The rent right now is something in the $1,900 range. So as you can see, 3% is a very modest estimation of how much rent you'll have paid over 30 years. Then if you look at as a homeowner with 4% appreciation, that $200,000 asset that you bought 30 years ago, not only will you have paid down all that debt, you'll now own an asset that's worth $648,000. So from the negative of 570 as a renter to a positive of 648 as a homeowner is the $1.2 million net worth advantage you would have as an owner versus as a renter over that time period. And the great thing is if you don't already own your own home, Mike has a great program that's 0% down. Generally speaking, figure 3.5% down or more plus about $2,000. So it does not take that much to get into a new home when you consider when you rent a new place, it's first, last, and security. Now, just in case you're thinking, oh, 30 years, that's such a long time, let's look at a 3-year time period. So over 3 years, with 3% inflation for your rent, you'll have spent over $37,000 on your rent. Versus if you own the home with that same $1,000 monthly payment, you'll be missing out on the appreciation of almost $25,000 in just that 3-year period. And you'll have paid down your debt by over $9,000. So between the two of not paying out rent and earning appreciation and equity pay down, that's nearly a $72,000 net worth difference just over 3 years when you become a homeowner versus a renter. And as always, please raise your hand or jump in if you have a question. Okay, so now the owners of properties that I work with are buying real estate investments in one of 2 ways. The first way is, let's say, for example, I have a client, they just outgrew their one-bedroom condo in Center City, and then they are converting that into a rental, and they're taking cash assets they had and buying a new primary residence. And because they're buying a new primary residence, they actually closed last month, they didn't need 20 or 25% down, which is very common for investment properties. You can, if you don't have an FHA loan, you can buy your new primary with an FHA loan with as little as 3.5% down, or other conventional options, which might be 0 or 5 or 10% down. So for example, let's say your current monthly payment is $1,200, you rent out the property for $1,500, so now you have a $300 buffer. And let's say you put 3 to 20% down plus $2,000 on your new home, you move into your new primary. So that's one way clients are building their rental portfolio, using their own primary residence to do it. Now, strategy number 2 for owners, or strategy number 3 overall, is what I call split your equity strategy, meaning you're staying put in your current home and you're using financing from that current home to buy a new investment property. Or if you have other cash assets, you can use those cash assets. And the 2 main ways people are using the cash or the equity in their current home to buy a new investment property is to either do a home equity line of credit, which would be best done by Univest, BB&T, or a credit union. I would recommend, though, talk to Mike first, because he might be able to, well, he'll be able to compare your current mortgage interest rate on what you already have, and compare it to see whether it makes sense to do a cash out refi and redo the entire loan, and then get a new loan for the new home that you're buying. So, just to reiterate, you either take money that you already have in the bank and use it to buy a new property, or you take money out of your current property that you own, as long as there's enough equity, to buy the new property. And the 2 ways you can do that are the HELOC, the home equity line of credit, or a cash out refi. So in essence, since it's 2:07 and we only have 23 minutes left, I'm not going to dive deep into this mathematical equation, but in essence, if you took the time to sit with me and Mike and talk about, what's your purchasing power, and figured this out, after 30 years at just 4% appreciation, you could have $1.6 million in assets that you own outright. And basically your tenant is buying you your wealth. And whether it's paying for kids' college or paying your retirement, I don't know anybody who can save $4,500 a month, versus doing what we're talking about right here, which is to use the home that you own and use your home to build wealth over the long term. All right, 6 easy steps for wealth building. So really, the first thing is, let's together determine your purchasing power. So that's conversations with me, that's conversations with Mike and or the credit union. And then number 2, we'll identify areas and property types that fit your budget. We'll visit and analyze those properties, make an offer, go through the inspection and other contingencies, and then lease out whichever property is going to be the rental property. And next week, or 2 weeks from now, the property manager, JG Real Estate, my favorite of all time, they manage my properties, they will be the guest speaker. So you will not want to miss that. So really, step 1, should you accept this assignment, is to send me your primary address, how much you owe, what your monthly payment is on it, so principal, interest, taxes, insurance, and mortgage insurance, if any, and if there's any other cash assets for the purchase. And I can help you evaluate, what you might be able to afford, and show you an investment property. So are there any questions? I'll pause here before we get into the financing aspect. Are there any questions about what I've discussed so far? Okay. So before I hand over the mic to Mike, I just wanted to review with you some closing costs in Philly, some basic parameters of the home equity line of credit with Univest, and then Mike is going to go over 3 different kinds of loan options, and about your credit if we have time, and then we'll have a few closing announcements at the end. So if you're in Philadelphia and buying a $100,000 property, your closing costs are about $9,600. If you're buying a property that's $300,000, it's about $18,000. As an investor, keep in mind that you will have to pay this in cash at closing or finance it with the loan over the term of that new loan. And if you can, get a seller assist where you're that's basically what that is. And as an investor, you're maxed out at 2%. So for the $100,000 buyer, you can ask the seller pay for $2,000 worth of your closing costs, which really means you're paying for it over 30 years. If you're a $300,000 buyer, you can get $6,000 covered, through the seller assist, and you just need to bring about $12,000 to closing plus your down payment. When you're buying your first home, and this is nationally, because I know we have somebody on the line who's not in Pennsylvania, these are national. The loan seller assist limits are national, so you could get a 4 or 6% assist in many cases when you're buying a home that you will live in. All right, so some basics of the Univest home equity line of credit. So there are going to be credit score requirements. The maximum you can borrow against a primary residence is 85%. So if, for example, you own a $100,000 property and you owe $50,000 on it, you're allowed to borrow up to $35,000 more. If it's a rental property that you're getting a home equity line of credit on, the loan to value maximum is 75%. So you could borrow $25,000 if you already owe $50,000. That way you have 25% equity, or 25% and 25,000 equity still in the home. And for an investment property, the maximum of $100,000 is allowed to be borrowed. It's amortized over a shorter term than your typical 30-year mortgage. It's amortized over 20 years, which means the payment's going to be higher. But because these loan amounts are so much less than a typical primary mortgage, the difference is not going to be felt. And you can also pay interest only over the life of the loan. So for example, if you're borrowing $60,000 or $100,000, and in 30 years, a $100,000 property is going to be worth over 300, you might say, well, my tenant's been paying it down, paying off the interest. I don't care that I still have that debt on my debt rolls. If you needed the cash flow in the meantime, that bears having a longer conversation, to explore all your options and what really makes sense. And if you have a financial advisor, definitely run those numbers with him or her. And also consider that it takes about 3 to 6 weeks from start to finish to get these HELOCs up and running, which is basically like a credit card, or excuse me, a checking account against your house. So it can never hurt to start that, open that now, so that way when you see an investment property or the new home you want to buy pop up on the market, you can move fast because you already have the money in place. Just one caveat, do not buy a car with it, do not go on vacation with it. It's really just meant for you to build more assets, more wealth over time. So use it wisely. All right, here's Mike Gliatone from Center City Mortgage and Investments. And I'm going to, I think we'll see your face once you start talking, Mike. Take it over. We might have some technical difficulties here. Let me just unmute Mike. Sorry, Mike. There we go. Are you there?
Okay. Yes,
right.
I'm here.
All right, look who's
Good. Well, Stacy, thanks again for having me on today's webinar. Excited to share some creative financing options, both standard as well as some alternative means and ways that folks can go about building wealth through investing in real estate. So since we're pressed for time, I'm going to jump right into it. And the first strategy that I want to talk about is renter to owner financing options. You mentioned this a little earlier in your move up strategy. So with this strategy, you can purchase a home that you're preparing to move into. Let's just say it's going to be a condo. It's just yourself. You don't need anything big. A 1-bedroom condo is suitable for you. The maintenance is low. You can buy that condo with a conventional loan and use a program that we have that requires 0 down payment. It also requires a 6% seller assist, so that would cover, most, if not all, the closing costs. And that program only has a $1,000 minimum out-of-pocket contribution. So you could buy your first property for as little as $1,000, which would be far less than renting. First month, last month security, certainly going to be more than $1,000, especially in our market. So you can acquire that property, start building equity, and then when you're eventually ready to move up, let's say you want to buy a single family. Now you can go buy a 2-bedroom, 1-bath, single family property. Go use another primary residence loan and do it all over again, 0% down or 3% down. So you can keep using that strategy and buying up, and each time you're taking advantage of primary residence loans, which are always going to be the lowest interest rate and lowest out-of-pocket options. So if you have an interest in multifamily properties, so 2 to 4 family homes, let's just say, you're an aspiring real estate investor, you like the idea of more units because you're scared about a single family losing a tenant, you don't want to cover all of that mortgage payment, well, perhaps a multifamily is something to consider. There are conventional financing options for 2 to 4 families with as little as 5% down. Some additional requirements that go into that program, so that's a separate conversation. But hey, great way to get conventional financing with not too much out of pocket for a multifamily property. And then last, FHA presents a really unique opportunity because it doesn't matter the number of units. It could be a 1-family or it can be a 4-family property. You can purchase that home with as little as 3.5% down. And again, kind of going back to option number 1, FHA allows for a 6% seller assist. So if that's something you can secure, you can purchase, a triplex or a quad as your first property, live in one of the units, and then go buy a duplex the next time around and continue to pick up multifamily homes, just buying up in some way. And buying up with multifamilies usually means decreasing the number of units because it makes more sense for you to go from a 4 to a 3 to a 2 versus the other way around. When an underwriter looks at you living in a duplex and go into a 4-family, becomes a little bit of a harder sell. But FHA is a great financing tool that can allow you to take advantage of those multifamily purchases. So if you already own a home, you own your single family, you're married, you have children, where you live just makes sense for your lifestyle, then you're going to have to consider using the standard investment financing options. And what I'm going to talk about today are what's known as conforming loan programs. And I'm sure some of you have heard, the names Fannie Mae and Freddie Mac. They set the underwriting requirements for all banks and lenders to follow when you're purchasing property using a loan that's going to be within their limit. That's a few bullet points down. So the reason it's called conforming programs is because we need to conform to what their underwriting guidelines say. So for down payment, the minimum required for a single family only, so here's where you can see things start to change, is 15% down. Now I will say, 15% down on an investment property, terms can definitely get better with 20 and 25% down. But look, if it's what you have to work with, it's not all that bad, and it is an available option. But when you get into 2 to 4 family properties, there is going to be a minimum down payment requirement of 25%. So Fannie Mae will also allow up to 10 finance properties. So what does that mean? Let's just say you have 20 properties in your portfolio, but only 5 of them have mortgages on them. Well, then you're still eligible to use these conforming loan programs to purchase another 5 investment properties and use mortgage financing with. And why these options are preferred is this is where you're going to find your traditional 30-year fixed rate, 15-year fixed rate with much more reasonable interest rates than some of the alternative options. Loan limits, I mentioned before, you can see based on number of units, it steps up. So in the Philadelphia or greater Philadelphia area, these loan amounts should pretty much take care of an investment property purchase, depending on the size and number of units in the property. If not, we do get into alternative financing options, sometimes jumbo financing options, where things are going to start to look a little different. So staying within this realm certainly has its advantages with respect to cost effectiveness. Fannie Mae, Freddie Mac, they require at least a 620 credit score. What I will say is, if you're between the 620 and the 680, sometimes it gets a little hard to get them to give us eligibility simply because there's a lot of technology used in the lending process today. And loan applications and credit reports have to pass through their technology programs and give us an eligibility recommendation to issue that pre-approval. So sometimes when the credit is on the lower side, we're not able to secure that eligible recommendation. But 680 and above, typically we don't seem to run into any issues. So if you're in that category or you need to get into that category, I've got a slide, a couple more in that'll give you some credit tips. Another advantage for conforming loans is first-time investors are allowed. So you can, and I just, have the perfect example. I have someone who lives and works in New York. Not reasonable for them to purchase a home and call it their primary residence in Philadelphia for the most part. So they don't own a property, they rent, but they were able to purchase a single-family investment property here in Philadelphia, and she may wind up moving into the property in a couple years. But she got in now. There was no prior landlord or home ownership experience, and she was a true first-time investor. Now last, and this could be an important one, Fannie Mae, Freddie Mac, they require the deed to be in the person's name. The deed is the ownership instrument for the property, so they do not allow an LLC or corporation to be the true owner of the property. Why LLCs are popular amongst investors is because they do provide protection against your personal assets if there ever is some type of litigation. However, if something happens, if there's a slip and fall incident, it's still the owner of the LLC showing up to court, paying attorney fees, and potentially having to figure out ways to pay out on claims should you ever run into that situation. So some level of protection there. What you can do to just get it in your personal name and protect yourself, LLC or not, is just over-insure yourself. Get an excess umbrella liability policy, 1 million, 2 million, probably costs you only $250 to $350 per year. Same price as filing an LLC tax return, and you now have more than enough insurance coverage to protect you should there ever be an incident in the property. Next, if for some reason you can't qualify for a conforming loan, maybe you have more than 10 finance properties, maybe your tax returns don't show a lot of personal income because you're self-employed. Well, there are options out there. The terms will look a little different, but options that allow you to buy a property with no income, no employment, nothing referenced on the loan application. All that needs to happen is there needs to be a debt service coverage. So for example, let's say the property you're purchasing has a total mortgage payment of $1,500. If the market rent for the property supports $1,500, that's what's being used to qualify. This also allows for a minimum of a 20% down payment. So let's just say you want a 2 or 3 family. Can't do the 25% down through Fannie Mae or Freddie Mac. You could put 20% down in one of these alternative options. Since property is more heavily relied on, credit score is going to be a little higher. There are no limit on the number of properties that you have financed. You can have 100 financed properties. You're fine. Loan amounts go higher. So if you exceed the Fannie Mae, Freddie Mac limits, we start looking at this as an option. This does require some level of home ownership. So you need to at least own a primary residence. In some cases, some may require you to have some landlord experience, but at least a primary residence is a must. But again, if the LLC is an absolute must-have for you, this type of financing option will allow the deed of the property to be vested in the LLC. Other financing options that are popular with investors are renovating. So you can probably get a good deal and build some net worth if you look at a property that needs some work. Maybe it's grandmom's house, pink tile, pink toilets and wallpaper everywhere. A lot of people aren't interested. You can maybe get that home at a good deal, so you're already capturing some equity going in, and then you use renovation loans to help further improve the property and add more value. So in the end, you could potentially be, 50 to 100,000 positive in equity, simply between your acquisition cost and the improvements that you make. If you're a single family buy and hold investor, Fannie Mae Homestyle is going to get you the best terms. You got to put at least 15% down of your total purchase price and your construction costs. But if you're interested in flipping, or you're looking for 2 to 4 family properties to renovate and hold, you'd have to use private money, simply because Fannie Mae and Freddie Mac do not have renovation programs in the 2 to 4 family investor category just yet. So the exit strategy for private money would be fix and flip, sell it quickly, or refinance over to a traditional loan once you finish your renovations. And then lastly, just wanted to give some tips on ways to improve or maintain your credit. And in that pie chart there, you're going to see exactly what makes up someone's credit score. So payment history, keep up with your payments, 35% of your credit score. That's powerful. Keep your credit card balances below 30% of aggregate limits. So if you have $10,000 in total credit card limits, you're going to want your credit card balances to be at or below $3,000. Continue to build your credit history. Don't be afraid to open new accounts. If you open them, just make sure you can manage them, because building your credit history will continue to add to your credit score 15%. Keep your credit inquiries low. It is okay if you're shopping for a loan to have a few credit pulls, as long as it's done within 2 weeks. Consumers are allowed to shop for credit now, so the credit bureaus will not hold it against you if you're having a few credit pulls done from the same service industry. Just don't start getting inquiries for credit cards and auto loans and mortgages. When they see scattered inquiries like that, that's when they start to negatively affect your credit score, because that's a red flag. And then lastly, get different credit types, installment loans, so car lease payments, auto personal loans, revolving loans, revolving credit, home equity lines of credit. Having a different balance of credit types will help make up that final 10%. And between all these, that's where you reach 100% of your credit score.
Awesome. Thank you, Mike. I'm going to unmute our attendees in case anybody would like to unmute themselves and ask a question as I just finish up our slides. And to get a quote for your refinance and purchase, reach out to Mike. Here's his contact information. It's also available as a handout to download from the webinar. And then for home equity lines of credit or loans, home equity loans, Univest, BB&T, or your local credit union, their information is right there. Again, we're open for questions. And again, a plug for Hosts for Hospitals. So basically, this is people opening up their homes for people who are visiting the area to get medical treatment at our hospitals. So if you have an extra bedroom in your house and are willing to host somebody to help them save money while they're going through a very hard time, they might be here for a very specialized treatment and it's costing them a lot of money, and it's just nicer to stay in somebody's home than necessarily a hotel, and that gets really expensive. So email them. They'll have a home visit with you to see if it's right for you and for their program. In 2 weeks' time, we have processing a tenant and property management. So JG Real Estate will be our guest speaker. And then following that, we'll be talking about analyzing an area and a property for flip or rental. And we'll have an attorney, Alan Nachemson, on. And then in the last session, we'll have Ryan Fisher from Camaplan, where we're going to be talking about how to use a self-directed IRA to buy real estate. And we'll talk about some other advanced topics. Again, we're open for questions. And at the end of the PowerPoint slides, which again is a handout, I have the dates and all the contact information for all of our sponsors and guest speakers, including me. And of course, the resources from Keller Inc. of MREI, the Millionaire Real Estate Investor, Hold, and Flip. So it is just about 2:30. Thank you so much for joining us. I will pause and wait in case anybody has any questions. And if not, thank you so much for coming. And thank you, Mike.
Thank you too, Stacy. And thanks everyone for joining in today.
Great. See you in the office.